What if I told you that you could retire in just 15 years instead of spending 4 decades grinding at a desk? Most people think retirement is something that happens in their 60s or 70s, but the truth is that with the right strategy, disciplined investing, and a clear plan, you can build enough wealth to live on your own terms much sooner. If you're serious about financial freedom and want to learn exactly how to make this happen, please subscribe to the channel because we're diving deep into the strategies that actually work. Retiring in 15 years isn't some fantasy reserved for lottery winners or trust fund heirs. It's a realistic goal for anyone willing to take control of their finances and make intentional decisions about where their money goes. The key lies in understanding 3 fundamental pillars: how much you need to save, where to invest that money, and how to let compound interest do the heavy lifting for you. Let's start with the math. If you want to retire in 15 years, you need to know your number. This is the total amount of money you'll need to live comfortably for the rest of your life. Most financial experts suggest you'll need about 25 to 30 times your annual expenses saved up. So if you spend $50,000 per year, you'd need somewhere between $1.25 million and $1.5 million. This might sound astronomical, but remember that you have 15 years of investing ahead of you, and compound interest is going to be your greatest ally. The power of compound interest cannot be overstated. When you invest money, you earn returns on that initial investment. But here's where it gets magical. Those returns then earn their own returns. Over 15 years, this compounding effect can transform a modest amount of monthly savings into a life-changing sum. If you invest $10,000 per month and achieve an average annual return of 10%, which is historically in line with stock market averages, you'd have nearly $2.3 million after 15 years. That's the power of compounding working in your favor. Now, where should you actually invest this money? The most straightforward path for most people is a diversified portfolio of low-cost index funds. These are funds that track entire market indices, meaning you own a tiny piece of hundreds or thousands of companies at once. This diversification protects you because you're not betting everything on one company or sector. If you invest in a total stock market index fund or a broad international index fund, you're capturing the overall growth of the economy without needing to pick individual winning stocks. Many successful early retirees follow what's called the 3-fund portfolio approach. This means you divide your investments among a total U.S. stock market fund, an international stock market fund, and a bond fund. The exact percentages depend on your age and risk tolerance, but a common allocation for someone in their 30s or 40s might be 60% stocks and 40% bonds. As you get closer to retirement, you gradually shift toward more bonds to protect your wealth from market volatility. Tax efficiency is something most people overlook, but it can make a massive difference in how quickly your wealth grows. If you're still working, contribute the maximum amount to your 401k if your employer offers one. In 2024, that limit is $23,500 per year. If your employer matches contributions, that's free money you absolutely cannot leave on the table. Beyond that, max out a Roth IRA if you're eligible. You can contribute $7,000 per year to a Roth, and all the growth inside it is completely tax-free for life. For money beyond what fits in these tax-advantaged accounts, you'll want a taxable brokerage account. The key here is to invest in tax-efficient funds and to avoid excessive trading. Every time you sell an investment at a profit, you owe capital gains tax. By holding your investments long-term and letting them grow, you minimize these tax bills and keep more money compounding for you. One critical element of retiring in 15 years is controlling your expenses. You can't just focus on earning and investing. You also need to make sure you're not lifestyle creeping as your income grows. Many people increase their spending whenever they get a raise, and that's a fast track to staying on the hamster wheel. Instead, try to keep your lifestyle relatively stable and direct all your raises and bonuses toward investing. If you get a 5% raise, put that entire 5% into your investment accounts. Your lifestyle doesn't change, but your wealth building accelerates significantly. Your savings rate is actually more important than your investment returns when you're aiming for early retirement. If you can save 50% of your income, you're on track to retire much faster than someone saving 10%, even if both are earning similar returns on their investments. This is why controlling expenses and earning more through side income or career advancement becomes so crucial. The gap between what you earn and what you spend is where your financial freedom comes from. Let me give you a concrete example of how this works in practice. Imagine you're 30 years old, you earn $100,000 per year, and you manage to save $50,000 annually. You invest this money in a diversified portfolio, earning an average of 10% per year. After 15 years, at age 45, you'd have accumulated approximately $2.1 million. If you live on $40,000 per year, you'd have more than 50 years of expenses covered. You could retire immediately and live comfortably for the rest of your life. That's the 15-year retirement dream in action. Of course, real life is more complicated than a simple example. Markets don't go up 10% every single year. Some years you'll see 20% gains, and other years you might experience a 20% decline. This is why you need to build in a buffer and not plan your retirement on razor-thin margins. That $50,000 you spend today might cost $75,000 in 15 years. This is why your target retirement number should include a realistic inflation assumption, usually around 3% per year. One of the biggest mistakes people make is trying to time the market or picking individual stocks. Even professional investors struggle to consistently beat the market, and most don't. By investing in low-cost index funds, you're essentially betting on the long-term growth of the entire economy, which is a much safer and more reliable approach. You don't need to be a genius stock picker to build generational wealth. You just need consistency, time, and compound interest. If you're finding this information valuable, please like this video because it helps us reach more people who are serious about their financial future. Another powerful tool in your retirement arsenal is real estate. While stock market investing is the most straightforward path, real estate can accelerate your timeline significantly. If you purchase rental properties, you can generate passive income that covers your living expenses while your properties appreciate and you pay down the mortgage with someone else's money. Some people retire in 15 years primarily through real estate, others through stock market investing, and many through a combination of both. If you decide to include real estate, focus on cash flow. You want properties that generate positive monthly income after all expenses are paid. This means rental income exceeds your mortgage, property taxes, insurance, maintenance, and vacancy costs. Over time, as you pay down the mortgage, your cash flow increases. By the time you retire, you could have several properties generating thousands of dollars per month in passive income, allowing you to maintain your lifestyle without touching your invested wealth. The real estate route does require more work and capital than pure stock market investing. You need to save for a down payment, manage properties or hire someone to do it, deal with tenants, and handle maintenance issues. But if you enjoy this type of active investing, the returns can be exceptional. Many people find that combining a primary residence, 1 or 2 rental properties, and a diversified stock portfolio creates the optimal balance of passive income, growth, and security. Let's talk about the psychological aspect of early retirement investing. You're going to watch your portfolio grow, but you're also going to watch it decline at times. During market downturns, which happen every few years on average, your account balance might drop 20 or 30%. This is completely normal and historically temporary, but it tests your resolve. This is why having a clear written plan matters so much. When you know you're following a strategy that has worked for thousands of investors before you, you're less likely to panic sell during downturns, which would lock in losses and derail your timeline. Stay invested during market crashes. This is where most retail investors fail. They panic and sell near the bottom, then miss the recovery that inevitably follows. If you're 15 years from retirement, market crashes are actually a gift because they let you buy more shares at lower prices. Over time, this dollar-cost averaging smooths out the bumps and ensures you're not timing your entry or exit based on emotions. Your career trajectory also plays a significant role in reaching the 15-year goal. The higher you can push your income, the more you can save and invest. This might mean pursuing promotions, changing companies to increase your salary, developing in-demand skills, or building a side business. Some people can save 50% of a $100,000 salary, while others might save 50% of a $300,000 salary. Both reach their number eventually, but the second person reaches it much faster. Prioritizing income growth early in your career compounds over time, just like your investments do. When you're getting closer to retirement, typically in the last year or two, you'll want to transition your portfolio toward a more conservative allocation. This is called de-risking, and it reduces the volatility of your wealth right when you need stability most. You don't want to retire and immediately experience a 30% market crash that threatens your financial security. A common strategy is to keep 2 years of living expenses in cash or bonds, another 3 to 5 years in a mixed stock and bond allocation, and the rest in stocks for long-term growth. This layered approach means you can weather a significant market downturn without having to sell stocks at depressed prices. You simply live off your cash and bond reserves while you wait for the recovery. This takes the pressure off and removes the temptation to make emotional decisions during bear markets. It's one of the most important psychological tools for successful early retirement. You should also establish what's called your safe withdrawal rate before you retire. The most commonly cited rule is the 4% rule. This means you can safely withdraw 4% of your portfolio each year without running out of money. So if you have $2 million, you can withdraw $80,000 annually and adjust for inflation each year. Research suggests this withdrawal rate has a 95% success rate over 30-year periods, which gives you a solid margin of safety. Some people prefer a more conservative withdrawal rate of 3.5%, especially if they're retiring very young or plan to live into their 90s. Others are comfortable with 4.5% or even 5% if they have flexibility to reduce spending during market downturns. The key is to have a specific number in mind before you retire, so you know exactly when you've reached your goal. Insurance becomes increasingly important as you approach early retirement. You need adequate health insurance until you qualify for Medicare at age 65. This is a significant expense that many early retirees underestimate. Look into health insurance marketplace plans, sometimes called Obamacare plans, which often become affordable when your income drops to zero. You might also qualify for subsidies that significantly reduce your premiums. Don't skip this step in your planning. Disability and life insurance also deserve consideration. If you're relying on earning a high income for the next 15 years, you need disability insurance to protect that income stream. If anyone depends on you financially, you need life insurance. These are relatively inexpensive ways to protect your wealth-building plan from catastrophic interruption. Let's talk about the lifestyle changes you might expect in early retirement. Most people find that retirement is actually more satisfying than they imagined because they're no longer stressed about work. However, you do need to find meaningful activities and purpose. Some early retirees travel extensively. Others start passion projects or side businesses. Some volunteer, and many simply spend time with family and friends. The freedom to choose how you spend your time is often more valuable than the money itself. One common regret among early retirees is not building a strong community before they retired. When you're working, your job provides social connection and purpose. When you leave, you need to have built up other sources of meaning and belonging. Start thinking about this now, not when you retire. Develop hobbies, join clubs, cultivate friendships, and build a life outside of work that you're excited about. As you get closer to your goal, consider working with a fee-only financial advisor who can review your plan and help you optimize it for your specific situation. Look for a fiduciary advisor, which means they're legally obligated to act in your best interest, not a commission-based advisor who might recommend products that benefit them more than you. An hour or two of professional advice could save you from costly mistakes and give you confidence in your timeline. Your biggest advantage right now is time. Compound interest works best over long periods. If you're in your 20s or 30s, every year you delay starting costs you significantly more when you finally do start. If you're already in your 40s, don't worry. You can still make this work, but you'll need to save more aggressively. The point is to start now. Start with what you have, and let time and consistency do the rest. Retiring in 15 years is absolutely achievable if you follow these principles. Save aggressively by keeping expenses low and income high. Invest in diversified, low-cost index funds. Stay invested through market ups and downs. Manage taxes efficiently with retirement accounts. Consider real estate if it fits your skills and interests. Adjust your allocation as you get closer to your target date. And always remember that your behavior matters more than your intelligence. You don't need to be a financial genius. You just need to be consistent, disciplined, and patient. The 15-year retirement path isn't for everyone, but if it resonates with you, now is the time to commit to it. Write down your number, calculate how much you need to save monthly, and set up automatic transfers to your investment accounts. Make it happen automatically so you don't have to think about it or have the willpower to skip it.